Is the gold bull market over? Let's understand. In the first four parts of the series, we explained why gold rallied and why it crashed. Now comes the final question. Is the gold rally actually over? Do you remember the three shocks we discussed in the part 4? One of them was oil shock. War pushed oil higher. Higher oil increased inflation fears. Inflation fears kept interest rate high, and higher interest rates hurts gold. But now the oil is fallen sharply from its all-time highs. One of the gold's biggest headwind is beginning to fade. The same chain that pushed gold down is now starting to reverse. But here's what matters the most. Through all of this, central banks never stopped buying. In fact, net central bank purchases were still up 3% year on year, despite Russia and Turkey selling. China has now bought gold for 19 months consecutively. And when price fell, it didn't slow down, it accelerated. That tells you something important. China isn't trading gold, it's building strategic reserves. Today, 9% of China's foreign reserves are held in the form of gold, as per the official sources. But China has been acquiring gold unofficially as well. So the actual number could be 2 to 3 times higher, while some of the developed countries hold as high as 70% in the form of gold. That's a huge gap. And if China keeps moving towards the levels seen in developed economies, this is a story of years, not months. Now, even after this correction, some of the major global institutions still expect gold to finish the year above today's price. Goldman Sachs, one of the more cautious voice, still expects gold to trade around $4,900 by the end of this year, which is approximately 20% higher from the current price. Forecasts are not guarantees, but they show that many institutions still believes this is a correction rather than the end of the trend. So is the bull market over? No one knows for certain. But here's what we do know. The reasons why central banks have been buying has not changed. Reserve diversification is still happening. Central bank demand is still there. Inflation fears are way below the level they were at the start of the war. So the price is corrected, but the thesis didn't. At least not yet. With that, do let me know your thoughts on the same. And if you enjoyed this series and learned something valuable, then do follow Credible Capital. And don't forget to check out the pin carousel for every chart, every source, and every number behind this analysis.